the Fed came out, said they're keeping rates low for the next till 2023. Does that mean you underwrite for cap rate compression? Does that mean you underwrite for cap rate growth or increase, for cap rates to go up? I don't think you can do either, right? I think you just have to use that stress test of what happens if cap rates go up, what happens if cap rates stay the same. If cap rates go down, it's a win, right? We never will underwrite for cap rate compression.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grenzig.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. With me, as always, is John Cohen. How we doing?
We're good. We have, I think, an exciting episode coming up, right? We don't know, but
yeah.
I'm hanging in there.
Yeah, we figured we would try something new. No guest today, just John and I. Figured we would just chat and do it a little bit different and, give it a little change of pace. You guys get to hear a little bit more of us instead of the guests this time, and hopefully you like it, and hopefully this one isn't our worst episode to date. But
I was going to say it's no one wants to talk to us anymore, and that's why we're doing it by ourselves.
Exactly. Yeah. No, people only like us because we say very little.
Exactly.
But awesome. I figured we would just take this time, talk a little bit about just kind of what's going on in the world today. Just kind of give our thoughts and opinions. Took a few questions from people too, so we'll probably answer those later and just, I don't know, just chat and see how it goes. I have no idea how long this is going to go, so we'll see what happens, but I think it'll go well. I think it'll be fun. So you want to just kick it off, I guess, just, wherever it takes you. What do you see?
A little intro about myself, my background. So
fair, there might be people who don't know, but you can look that up another time. I mean,
exactly.
You've done an Us Guest podcast, so go check those out. But I mean, what's top of mind for you with everything going on? Because there's obviously a lot, we could go in a million different directions, but as you kind of think about, real estate today, the market today, the world today,
it's interesting. I think, I mean, people listen to our last couple of episodes, I'm normally negative, right? I'm always talking about the bad stuff. There'll be there's a lot of things that are stacked up against good right now. There's just a ton of people not working, forbearances on homes and foreclosures being postponed, evictions, all different rules all over the place. New York just extended to the end of December, but you could get judgments on money owed. So it's, you see some silver lining in everything. It's like, okay, when are we going to get back to normal? And I think we're on the right track. You see the governor in Florida telling people, I don't care 100% capacity, right? I don't care, it could spike. DeSantis, right? I'm pretty sure that's what he basically came out and said, restaurants 100%, everything 100%. I don't care, right? Cases can spike, whatever, be that as it may, we're not closing anymore. Now that, maybe that's the case. Maybe that's not, that's what he's just saying. And, we are getting closer to a presidential election. So you got that battling against us. We just found out that Trump hasn't paid taxes since, before time. He owes, a ton of money, benefits of real estate, right? But you do see good things happening. And, the single family world is upside down. It makes no sense. I mean, there's deals get listed and sold in a day, 12 hours, 24 hours, like a full price offers. So there's obviously a lot of people buying things, whether it's a single family house, rental portfolio, multifamily, self-storage, whatever it is, there's transactions taking place. We're about to close a mobile home park. I know Chris is buying a 16 unit. So you're starting to see, the light at the end of the tunnel. Now it comes as a big, with a big asterisk, you do got to keep in mind that there are people out of work. You do got to keep in mind that there is an insurmountable amount of debt. I got an email today that not one PPP loan has been forgiven yet. Now the SBA is fighting with, the small banks are fighting with the federal government because of all this stuff. Multi-Housing News is suing the CDC because of the eviction thing that they put together.
I saw that, yeah.
So as much positive as you start to see, right? It seems like cases are coming down in certain areas. It's a little bit back to normal. Uh, we're super excited about it. I mean, we had a call, just before this about putting really good framework together for the end of Q4, so it's not a hangover, right? I think everyone's got to get out of the 2020 mindset. Start setting up the foundation today for your 2021 to hit it, to start it off with a bang. And you just got to be a little leery, right? You just got to understand what you're buying, the demographics of what you're buying, the location of what you're buying, and what you want to attack, because there are still good deals out there. There are deals that are transacting. There are banks that are lending. There are deals taking place. So to sit here and say the world's coming to an end and nothing's going right, I mean, that's crazy, right? No one has a crystal ball. No one knows that. But what I personally feel is that I can see us getting back on track, right? I say it all the time, a good real estate investor has the contacts to get your, everything going in the right direction when something gets offset. Well, I could start seeing the light at the end of the tunnel. I see us coming back to normal. And when I say normal, I think that 2021 is going to be tough here also, from a standpoint of, are we going to buy 20 deals? No. Are we going to buy, one deal? Nah, no, I think we could probably buy a couple. I think that, we would sell a deal if it was the right time to sell. But overall, I think that everyone's got to roll up their sleeves. This is the new normal we live in, and you got to adapt around it, right? We could all bitch and moan and complain and blah, blah, blah. But that's not going to get anything going forward. And I'm just a huge believer of, play the cards you're dealt. It doesn't mean you have to fold, or it doesn't mean you have to go all in, but, hang in there, right? And I think that's where we're at. We're going into, summer's over, fall's here. Next thing you know, it'll be Thanksgiving, Christmas, the holidays, and then New Year. And, we all know what happens December 31st, right? Everyone's got these long visions of, I'm going to lose 50 pounds. I'm going to get into shape. So there's no reason to not put that together. And I think this list is going to be even better because, just a ton of bad shit happened in 2020. So I think that you can see the light at the end of the tunnel, and you should be excited. Everyone should be excited because we're getting closer to what's normal. And this may be the new norm, but at least, things are coming together. That's how I feel.
Yeah, I think where I sit today, things that I'm thinking about that I have zero answers for, I'm very curious how the cold weather is going to affect things, not necessarily from the standpoint of how does it affect transmission or the virus, but of now people are going to be indoors and in closer proximity, or you're not going to have a place to go. Just because Florida is opening up doesn't mean, a lot of the blue states aren't, talk New York. So it's going to be, how does that affect things, and how does that affect people's mindset and the market? If all of a sudden now it's not as nice out, you can't go anywhere because you can't be inside and it's too cold. Do people just say, I'm fed up with this, to hell with everything, we're done? Or do people kind of continue to stay the track? I do think more and more people are just kind of fed up with it and over it, and feel the reward isn't worth the risk of shutting things down anymore. Florida is saying everything's 100% occupied. That's kind of what it is at this point. I think the conservative side, without getting political, is definitely leading that charge. And I just think it's going to continue to bleed into other areas. And then also, there are several companies that are close to, or say they're close to getting a vaccine. So how does that affect things? But I agree with a lot of what you said. I don't think, at least in our sector, in multifamily, that it's been hugely impacted. I mean, it hasn't stopped our ability to renovate units and push rents to market. We just bumped some rates down in Florida. I'm sure we're bumping rates in Columbus, but that may just be a function of being below market and not having bumped them a lot. So, I mean, definitely an impact to lifestyle, but from the business side, the only thing that's really been impacted is some of the lending side of things. Cap rates have continued to come down, prices have continued to go up, and it just feels a little crazy. I did think probably a few weeks ago, I was very worried about the country snapping its fingers and going into total lockdown again. I think something incredibly severe would have to happen for that to happen again. Maybe New York and California, but I think 50% plus of the states are not going to go back into full lockdown, for better or for worse. I just don't think it's going to happen at this point. I think too many people are going to rebel against it. So that gives you some confidence of people's ability to pay, unemployment not spiking way back up, collections being able to be in a sustainable range, if not continuing to creep up. So again, from the business side, it's that risk that I've been seeing for the potential of things to get worse again in the future. It just continues to creep day by day in the direction that that risk gets less and less. So I don't know. I'm still nervous about what can happen. I still think pricing is crazy on 99.8% of deals that we see. And it's making us get a little bit more creative or strategic. But I do agree with you. I think deals are still out there.
Yeah, no, I think you got to take advantage of it. I mean, there are ways to de-risk stuff, right? The mobile home park we're buying, no debt. We're buying it cash. So we don't have to pay the reaper. It's our deal. We have to pay our expenses. That's it. So there are ways to mitigate your concerns. Now, would I go recommend someone go buy a $50 million apartment complex with no debt? Well, if you have the money, go for it, right? There's nothing wrong with that, right? There's nothing wrong with that, right? What I see a lot, and I said this, I think, on our episode with Jonathan Twombly, was what I've learned is that don't make the debt be the defining factor of the deal. Make the debt work for the business plan, but don't have the debt be the reason why you buy something. I saw a post today on, I think it was on Facebook, where a kid said, I got debt at 4% and I was okay with it because I had a lower prepayment penalty. And, the post made no sense because it was originated around debt. And I said, listen, that's great, but no one can predict the future. So everything you said, I think we're seeing stuff the same way. And there are ways to de-risk it, right? If you're going to get debt, maybe put a little bit more equity into it, right? And yeah, it's not all about leverage and maximizing your returns, but there are ways to go about a deal to scale down the risk. And I think that, we're having those conversations. We just spoke about, a little bit of lower leverage or whatever it is. I just think you have to go about your deals. There are deals taking place, and Chris is right, 98.8% of deals or 99.8% of deals are tough. They're not penciling out because insurance is changing, debt's changes, taxes are going up. And those three things alone make it difficult to buy a deal to make money. But how you can offset that is, maybe your risk-adjusted returns, and Chris speaks about that all the time. Understanding that is how you get a deal done. And if you don't have to buy a deal, no one said you have to buy a deal. But if you are looking for deals and you want to transact, you can. And I personally would, and I would encourage it. But look at the risk factors, and that's what we're doing now more than ever. It's just pulling the stress test levers. What happens if this happens? What happens if that happens? Now, I do think more bad things will happen in the regards of more people will lose jobs, and some people will retain jobs. Some people will go back to work, and I don't think unemployment's going to 30, but I think we can hover here, and there'll be some that lose and some that gain. So maybe it goes up and down, but you just want to be aware of what those levers are so you can put them in place. I don't think you want to financially engineer things. I don't think you want to put major market growth in. Maybe if you're a multifamily guy, you go down to the single family world. If you're a fix and flipper, maybe you go buy self-storage. I don't know, but there are ways and levers to pull that you just stress test your stuff. And that's how deals are going to get done. And that's what we're doing. We're looking at, what are the risks that we're willing to take on and what's the risk we're not. And that's how I think we're going to be successful. We're going to buy deals. We're going to underwrite deals, and, we're going to get aggressive when we have to get aggressive, and we're going to, scale back if it's not everything we want.
Yeah, I think one thing too is we talk about risk that I tend to forget about, but it's hitting us right now is, the world's so interconnected. It's not just what we're doing. And the perfect example is right now we're having a hard time getting appliances for a lot of our properties because a lot of ports overseas are shut down. I think from what I've heard, and this could be wrong because I heard it from other people, but the ports in China got re-locked down because they had a surge in cases. So that's made getting appliances from over there tougher to get. And because there's less supply, the pricing has gone up and nobody wants to pay more than they did in the past for appliances. So it's something like that that's totally not related to our bubble or our geography, but it's having a direct impact on what we're doing. I know right now, I think lumber prices are like through the roof, and that's hurting a lot of developers. Same with labor costs, I think too. I think I think I heard lumber like doubled or tripled in price in the last few months. And I mean, if it all of a sudden your lumber costs, which probably makes up a good chunk of your budget for a new construction building, I mean, triples, that's going to severely impact the bottom line and what you think you can do or delay it. So I think we got to remember that there's always other things in the supply chain or further down the line that also impact what we're looking to do. But you started touching on one thing that may be interesting to talk about, kind of the relationship between where you can borrow debt at and where you're going to buy commercial property based on the cap rate. And one of the things that we saw was debt came, back in like January, debt came way down. Then it spiked when COVID hit in March, April, May, and it's come back down, not probably to those same levels, but pretty close. And we've seen cap rates kind of come down with it. And the argument kind of for that is, well, the spread between what you can borrow debt at and what you can buy a commercial property at on a cap rate has, quote unquote, never been this large in several years. So therefore your cash flow will be higher. How do you view that relationship in terms of debt, cap rates, value, what cap rates are going to be in the future, replacement costs? Like, how do you think about all that?
That's a good question. So one, as debt becomes cheaper, cap rates go down.
Mm-hmm.
Personally, if someone speaks cap rate language, once debt is thrown into the weeds, cap rate goes out one year. It goes away in my mind, because your cap rate is is your return if you paid for it all cash. Once you throw leverage debt on there, you're now working on a cash and cash or something like that. So I think that the Fed came out, said they're keeping rates low for the next till 2023. Does that mean you underwrite for cap rate compression? Does that mean you underwrite for cap rate growth or increase, for cap rates to go up? I don't think you can do either, right? I think you just have to use that stress test of what happens if cap rates go up, what happens if cap rates stay the same. If cap rates go down, it's a win, right? We never will underwrite for cap rate compression. That's crazy.
Mm-hmm.
But I think you have to look at both, and you have to weigh out the value of either. Okay, if cap rates stay the same, we're fine. If cap rates go up, at what point does the deal become risky? Or what does, if you're going to refinance it, that's when when you put your cap rate, let's say you buy a deal at 5 cap and you're selling it at a 6 cap. If you sell it at a 6 cap and it's a 30 IRR, great, right? You can sell it at a 7 cap, not going to matter. You can sell it at an 8 cap, it's probably not going to matter. But if you're buying a deal and you're putting a 5.5 cap on it and you bought it at a 5 cap, I think what you have to do before you say, let's do it, is you got to look at your refinance situation at the end of that loan, whether it's a bridge loan, whether it's a Fannie, Freddie, agency, community bank. You got to look at what your exit option looks like. And I think that's what I would do. I would look at it and say, okay, well, we're going to put it at a 5.5 cap, which is something we typically don't, but we're going to do it. Let's look at scenario 1. Okay, 5.5 cap, good IRR, good exit. We cover our debt, no questions asked. I think that the next level of that is, okay, let's look at a refi scenario. Now, my refi scenario, I wouldn't necessarily put it in at a 5.5 cap because obviously we could sell there. So maybe my refi, I run it at a 6, a 6.25, 6.5, and maybe all the way up to a 7. And what happens on refi, right? At a 7, we still pull out our money. Okay, great. But the other level of the refi is your interest rate. So I think you got to, if you're refinancing in the next 5 years, do I think you should underwrite to a 12? No, that's crazy. But if you're going to refi out at a 6, 6.5, 7, maybe an 8 cap, whatever you feel comfortable with, and it's all market derivative, right? If you're in New York City or if you're in Tuscaloosa, it's going to be different. Mm-hmm. But I think you got to stress test your refi, maybe at a 4, a 5, a 6. I don't think we're going to see 6s, but what happens if you refi at a 7 cap and it's a 6% interest rate on your new loan? Do you pull out cash? Do you need to put in cash? And simultaneously, is your new debt service, what's your DSCR? Can you cover your debt? And I think those are the levers you have to pull. Because to go into a deal and say, I'm going to buy it at a 5 and sell it at a 4, you're asking for a disaster. To go into a deal and say, I'm going to buy it at a 5 and sell it at a 6.5, I think you're inevitably going to be very it's going to be challenging to find a deal. I think that if you go into a deal, sell it at a 5.5, but you have those stress tests running in the background, you explain it to yourself, to your investors, and you educate. If it's your own deal, you have to educate yourself. If it's investor deals, you educate your investors. If you show them all of that, I think you're fine. And that's how I would go about looking at a deal. I would just look at all of those options and get comfortable with any of those options. Say, well, you know what? We did put a baseline case in here. And if you want to run it to a 2008, 2009, 2010, what happened in this market? I think you can do that too. But I think the major change between that type of underwriting and new underwriting is that in 2008, 2009, 2010, when you run those base cases of 20% vacancy and super, your interest rates were higher. It was tougher to get debt. Your leverage was different. So you got to keep that in mind. If you base case it to that, that's fine. But if the deal doesn't work, I don't think 2008 is on the horizon. I just personally don't think that. Could it be bad? Yeah. But I don't see that happening right now. But I think you just want to run your stress test scenarios and make sure, if you're buying a $5 million deal and you have $3 million worth of debt, you want to make sure your stress test doesn't allow you to pull out $1 million, or you only can refi $1 million. Now you're on the hook for $2 million and you got to figure it out. So you just want to be aware of that. And I think that's how you go about it. That's what I would do. I wouldn't necessarily care if cap rates go down, left, up, right, or sideways. I don't care if debt goes up, down, left, right, or sideways, but together you got to pull the levers. That's what I would do.
So one thing that I've been thinking about a lot lately as we talk about this is I remember somebody said something along the lines, I'll probably butcher it, in the single family world, that when interest rates are super high, your value is very low because basically your cost to buy is so high, you can't afford to buy it. And when interest rates come way down, your value goes higher because it just costs you less to borrow the money to allow you to buy it. And that's why I have friends that talk about our parents' generation basically bought homes for these crazy low prices in New York, and now they're worth these crazy high amounts because when they bought them, one, different time period, and a lot of people have moved here and a lot of work has been done, but also they were borrowing money at 8 to 15%, so you couldn't afford to buy it for today's prices. If you added in the cost of what the interest that you paid on it was, it would increase the value of that home tremendously. And that's why I hate talking to people about homes, because they don't add in any of the costs. It's just, what did you buy it for and what did you sell it for? They never factor in closing costs, agent costs, cost of interest, renovations you did to the home. None of that stuff is ever factored in. But I wonder if we're starting to see something along those lines of, to your point, 2008 to probably 12, you could hardly borrow money. And if you did, it was at much higher rates and your leverage was way lower. So just by the amount of capital that was out there that was willing to go into these deals in general was significantly lower. You had to bring more equity to the table. Thus, your value was significantly lower. So now that capital is fairly free flowing, and now with the rise of the internet, more and more people want to do it, and the rise of syndications, more and more people can get into it. I do kind of see that correlation of, we can borrow it for so much cheaper. It's almost a little bit of the correlation of cap rates. We'll pay so much more because it's just going to cost us less when you look at the cost of interest. But to your point, me personally, I do understand of, at some point it's going to go somewhat the other way. I got to imagine. I don't know if that's 5 years from now or 20 years from now. I can't see a way that interest rates stay this low forever, or maybe, I don't know, maybe negative interest rates is the new thing. If the world becomes so interconnected and risk is so low, do they go to negative interest rates? And parking money as debt in these things is just so risk free that you're willing to do it. I don't know. I do think about when I started 4 years ago. We were buying deals in the Carolinas at 6.25 caps. Stuff in Indianapolis was still selling for 7 caps. Stuff down in Florida was selling for 6.25 caps. Now we're talking about, C-class 1960s built stuff in, C minus areas selling for 4.75 to 5.25 caps. And I'm just like, that's, how does that work? If it can change that quickly in 3-4 years, why can't it change the other way in 3-4 years? I mean, 2 years ago when they were hiking interest rates 4 times a year, we were like, oh, we're going to get another 4. And then they lowered it. Then out of nowhere, they lowered it to 2. And they were like, oh, okay, we'll continue to raise it for 2. And then all of a sudden it was none. And then they just started dropping them and it just plummeted. So I don't know. I guess I view it as, I don't know if it's I haven't been in it long enough to kind of experience that, that relationship, or if it's just I'm very worried about the possibility that it flips the other way, and that if you buy something for a 4.5 cap, how are you going to sell it for a 6 cap in 7 years? I don't know.
Yeah, no. So I think it's interesting, right? Because you're right. In the last 5 years, it's gone, 6.25 to 4.75 on the same vintage property.
Mm-hmm.
And the only thing that's fundamental, well, there's been a couple fundamental changes. One, obviously, population growth and job growth has been ridiculous.
Yeah, for sure.
Which is huge. But the major factor is that the debt hasn't gone up, right?
Mm-hmm.
When it did go up, cap rates didn't move much. But now that it's going the other way, it's like that's the justification behind deals. Well, you could borrow money at 2.6, 3. But inevitably, you're still buying the same C-class vintage property in the same location.
Mm-hmm.
And that's where the disconnect is in my eyes, where I say, okay, if I'm going to go buy that property there, why don't I just go buy something in my backyard in New York? Not saying that New York is better or worse than anything else, but now whether, appreciation is going to be there in the future in New York, these are all different conversations, but that's where the disconnect in my mind is wait a second, why am I going to get on a plane and go to Alabama to go find a 4.5, 5.5, 5.75 cap if I can go buy a 6 cap in New York nowadays, right? Like, why would I go do that? And I don't think there's a right or wrong answer. I think it's just a personal, I think it's when you look in the mirror, whether you're raising money or it's your own money, I think you just got to make that decision. That's it. I think, and if you make that decision, that's the decision you ride with. But you're 100% right. Why can't it go just as quickly as it went down? Why can't it go up that way? Now, there's other factors involved. And, there was a chart I saw the other day, and maybe a month ago at this point, but it was like it showed interest rates from like 1960s to now. Mm-hmm. Basically, they've just dropped. There was a period of time where they went up, and that was right when our parents were buying stuff. But, like the houses that our parents lived in the 80s, those houses were built, Levitt houses in Long Island were built for $6,000.
Yeah.
Back in the day. So it's, you can't, it's all different times, right? So it's interesting because there's no crystal ball, but understanding all those dynamics and history repeats itself and all of that, and just being aware of that when you're going into something, that's all you can ask yourself for, right? Because none of us are going to know if interest rates are going up fast or not, or is negative interest rates, the new norm, or, any of that. So I think you just got to sit back, hang tight, buy things that are fundamentally sound. That's one thing that we're very big on now. It's location driven, right? I don't mind necessarily if it's in Florida or if it's in Ohio and nowhere else. I think you just want to understand where the physical asset is in the submarket. I think that is more important than anything nowadays, because job growth, population growth, all that stuff, a C-class deal is still a C-class deal. So you got to be aware of that, and you got to understand the risk associated with that. So, but other than that, I mean, it's your guess is as good as mine at the end of the day, right? These are just our opinions, and I don't care if someone hates my opinion or not, right? That's, we don't have to be politically correct. If someone likes me, they do. If they don't, they don't. But that's just how we're going to go about it. And if it's wrong and it's crazy, and there are people out there that want to buy deals at 4.5 caps and sell them at 3.5 caps, go for it. It just won't, you won't see that from me.
Right. Yeah, I think, and that's why, the past several episodes, it's come up a couple of times of investing in your backyard, that locality aspect of it, that inside knowledge, quote unquote. There's no insider trading in real estate, but if you know a development's going up around the corner, you can go buy something. There's nothing wrong with that. It's not like the stock market where it's regulated. The more you know about areas you're investing in and what's going on and who's doing what, you're just going to have more knowledge and more of an inside track than anybody else coming into that area. And you can probably evaluate it better than somebody else that has the same level of, let's say, skill or knowledge in real estate as you do. And yeah, maybe you're banking on, appreciation or taking a little bit of a gamble that it goes through or something, but you have that knowledge that somebody else may not, and you can act on it as you see fit. Whereas the other person who doesn't have that may not. And I think that's a big part of it that gets lost as we've gone more remote, more virtual, of, that hyper local knowledge and block by block understanding of what's going on. I mean, I looked at a property the other day, and it's around the corner from this new retail redevelopment. They're like redoing it, and it's great, but it's on the other side of it's so close. I could throw a baseball there basically, but there's literally a train tracks that separate it. And I still felt it was good enough, because if you go down one block, you can then go across those train tracks. But if it was like 6-7 blocks up, I would view it very differently than this one because of how close it is to it. And I think it's things like that you lose in translation when you do start going that virtual route.
Yep. No, I agree. I mean, it's understanding your sub market is extremely important. I could not be more on that side, right? That's, one of our best performing deals through Corona and COVID was a deal we bought in Jacksonville. In the middle of it, the sub market's rock solid. And that typically you're not going to take away when there's driving factors to a sub market.
Mm-hmm. Yeah. I mean, it's literally around the corner from the deal I'm buying. It's one of the reasons I'm buying it, because not only do I think the price is good, but I just think the area is awesome. I mean, it's just a really great sub-market, really great school district, and everything's built up there. So you really can't build anything new. Ton of natural barriers around it, so it just it's just a really good location. The fact that that deal's crushing it just gave me extra confidence. So, I don't know if 2 years ago, I don't know if I would have pulled the trigger the same way I did here without looking at a few deals there, seeing how a few other deals have performed, and then also buying a deal there. I mean, in that submarket alone, we've offered on probably 10 deals. We went under contract on one. We almost went under contract on the second one, and then finally closed that one. So, I mean, it was we've done a ton of work just in that submarket.
No, what we went under contract on 2. We bought one, and the one deal we got, we didn't go under contract. We got screwed.
Yeah, that's a story for another time.
It is.
I think we can actually parlay into this. I reached out and asked people to submit some questions for this because I think it would be good. So this is from Deborah Shea. If I say your name wrong, I'm sorry. But she asked, what should I be looking for in a partnership I'm going to invest in passively? So how do you assess the reliability and validity of the general partners and their numbers?
Obviously, you only invest in a deal sponsored by Toro. No, with all seriousness, though, I think there's the one piece that you're just never going to, it's the level of trust, right? I think people do business with people they like and trust. So I think that's something that you ultimately have to have. The deal could be the best deal in the world, but if something doesn't look right or something doesn't feel right or something doesn't check off the boxes, you got to think twice about that. The other thing you want to look for is, in my opinion, you want to look at some type of track record. And when I say that, I'm not saying that meaning that they have to have transacted on 50 deals, right? You want to make sure that they've done it. And that might not even be they've never even sold a deal, because their business plan may be to buy and hold forever for cash flow. You just want to make sure that they've gone through this type of transaction before in some way, shape, or form, whether it was a personal investment, whether it was a small investment into another deal. You just want to make sure that they have a track record, be it one deal, be it 50 deals. You want to make sure that they've at least done it and it's not their first. And if it is their first, you just want to understand why, right? Why are you doing this, and why am I being presented this opportunity? I think the other thing that you want to look for in any type of investment into a passive investment is just what are the assumptions being made based upon, right? So most people don't ask those questions, see if they'll provide you with the financials if you want to take a deeper look, but you want to understand the assumptions that are giving you the returns that are being projected. Because without understanding those assumptions, you may see a deal that has a great cash flow, but you realize that they're taking the expenses down from 50% to 20% on a 1970s built deal. And right there, the deal's not going to work unless there's, they have a magical, something different that they do. And, there's a component of it that is just completely unrealistic. But I think understanding why the assumptions are being made is the biggest thing for anyone, right? Having the education yourself to ask the question of why are you growing rents? Why do you think you can push rents? What is your, what are taxes going to? What is your insurance quote? Because those are the things that are going to make the deal work or not work, right? If they're going to raise rents $250, but they're going to be the market leader, maybe you don't make that decision. Or if you have a location that's that's completely ridiculous, maybe you can charge rents like that. But I think those are the things that I would look for from the passive side. Just making sure there's a level of trust, making sure that you understand the assumptions being made that are giving you projections, and some type of track record just to make sure that it's not they weren't selling fish at a fish store and now they're buying real estate, right? You just want to make sure that there's something they know why they're doing it.
Mm-hmm. Yeah, I think when you're looking at the deal specifically, I think the first thing that you can do is just get better educated yourself so you can understand, like you said, the levers that make the deal or the assumptions. Like you mentioned a few, the rent growth, why are their expenses the way they are? What is the capital stack? Where's the money coming from and how's it being used? The better educated you can be on all of that, the less you obviously have to rely upon them. So I think the most important thing is having some level of accountability for yourself. Obviously, though, there's only so much you can get educated on if you're truly passive. You've got probably other things to do, your own business, your own job, your own family. So, there is going to have to be that level of trust that you extend to someone. So I think another thing outside, I'm not going to try to reiterate too much of what John said because I agree with it all. Looking for a clear and concise plan for the property, I think is hugely important. You have to know, where is the ship going? Why is it going there? How is it going there? And if anything happens along the way, how are we going to make sure that the ship doesn't sink? How do we pivot? So it's multiple exit plans. It's strategic changes on capital if need be. If rents aren't doing what they need to be doing, how are we going to shift? So it's trying to poke potential holes in the plan and seeing how they would react to it, or what do they have in place. I think understanding why this property in this location is hugely important. As John said earlier, buying those great locations is super important. So why is this location great for the price it's at, right? Because even if it's not in a so great location, it's still probably worth something. If somebody gave you a free property that's worth $10,000, I think everybody would take it. So it's why that location for this price? Because you can have the greatest location in the world and pay way more than it's worth, may or may not be what you're looking for. So I think that's important as well. And then I think the biggest thing that people also need to understand is, what's the relationship going to be like between the general partners and the passive investors? Is this, something that you can have more, if you're looking to learn about it and they're just expecting you to write a check and just kind of get updated as it goes by, maybe it's not right for you. There's people that will be a little bit more hands-on, a little bit more transparent if you ask for it. Or if you're just really looking for someone that's super professional, you don't have to worry about it. They've got everything in place and you just really just want to be 1,000% passive, go and find that group. So it's understanding who you're looking to invest alongside with as much as the deal itself, because you're not just investing in the deal, you're also investing in that partnership. So you want to understand, who you're getting into bed with, how they do business, does it align with what you're looking to do, all that.
I like that.
Awesome. So we'll go to the next question. So this is from Umberto Rincon. Why is it better to buy old buildings than develop new properties?
Depends. That's the answer to your question. No, I think so. From my opinion, an existing property versus a development. Obviously, a development, if you're building it out of the ground, there's a time component that things can happen over time. As Chris mentioned earlier, uh, over 4 years, a lot's changed. Now, I'm not saying the development is going to take 4 years, but you start your development today for a future project. Now, if you're building a single family house, it might take 6 months. If you're building, it might take 3 months. If you're building a multifamily 300 unit property, it could take a year and a half. So you don't know where the world's going to be in a year and a half. If you buy an existing structure, well, the day you take over, you know what you have and you can rent it out. You can potentially cash flow the day you take over. So it's just a decision that an individual has to make, whether they want to wait a year and a half, maybe 2 years for cash flow, or do they want to take something existing, take the cash flow that's there, maybe make improvements, and also the type of debt that is associated with each deal. You buy an existing structure that's stable, you're going to get a better loan product that will help the business plan. On a new construction, there's less options available, especially for smaller developments, and bigger developments may be a little different. But the level of risk associated with development is obviously significantly higher than an existing structure.
Yeah, I agree. I don't think there's a right answer. I think it's all, a risk reward standpoint of what are you willing to take on and what are you looking to get back. You can go to, on one end of the spectrum, I think is that new construction development. And I think the other end of the spectrum is like your triple net leases, your REITs, just stable buying a leased up new construction deal. And then you've got stuff in the middle. So if you're talking about just the difference between new development and redevelopment, I think you have less risk in the fact that you have something standing already that's there. You don't have to worry about, you probably don't have to worry as much about, the land itself. It's probably already been evaluated to a certain level. Obviously, something could have happened in that time that makes it unattractive, or environmental problems, or the code could have changed so you can't have as many units. But you've already got something there that you can build off of. The 130 unit we did in Columbus was, a lot of it was already there. So it didn't cost nearly as much to, redo it as it would have to just build brand new. Obviously, it was a much smaller structure. It's only single story, small units. So if it was new construction, we would have never built what's currently there, but it was significantly cheaper than if we had built it new between what we bought it for and what we built it for. So it just removes a lot of that risk. If you have something that you're quote unquote redeveloping that already has tenants in it, well, now you've got cash flow coming in that offsets the carrying cost while you're doing all that. So, it's all a risk reward thing. And you're really looking for, when you're buying an investment property, you're looking for kind of an asymmetric relationship between, more reward than you value the risk at. So, do you think it's worth that risk and worth a lot more than what that risk is? That's how you view any investment. So it's just, the riskier the product is, the more likely you should expect to mess up a property or, one of your properties over time. We had a really good interview with Chris Ford where he was talking about that. Basically, I think he said, like, if I was going to open a shop, I would never do just development, because there's so many examples of, these ultra wealthy families that, develop a property, sell it, and then they roll all of it into the next development, or they just continue to roll all their money into all their developments. And then eventually they mess up and they lose it all, but they were these crazy wealthy families. And that's why he said at the time, he always envisioned doing, of 10 properties, maybe one development, because there's just less risk in that development failing and, just taking away all your money. Could still happen with existing multifamily redevelopment, any deal really, but just less likelihood of happening. Let's see. We got two more. So question for us specifically is, why do you guys invest in apartment rentals and not storage units? Maybe you do, but is diversifying your real estate portfolio important?
So we don't buy self-storage because we don't know enough about it. I can tell you early on, I thought it was a really attractive space. I educated myself basically enough to be dangerous and know nothing about it. We buy multifamily because that's what we picked as what we wanted to do. I was a former broker for Marcus and Millichap. My partner worked at Cushman Wakefield. Uh, it was just something we knew, we understood. I fell in love with the product type. That's the major defining factor. I knew it, I understood it, I liked it, and the demographic support behind it was just what we wanted to buy. Um, no reason why we don't educate ourselves on self storage, except for the fact that we wanted to be experts in multifamily. That was it. Other than that, from the diversification standpoint, it always makes sense to diversify. Whether you find an operator that really knows it, and or you educate yourself and you have a little diversification. Diversification is great. You don't ever want to have all your eggs in one basket. And you could diversify not only geographically, a product class, and then you could also go into a totally different product. So I think diversification is great. There's nothing wrong with it. From a standpoint of us, we want to be the multifamily guys for your diversification or for ourselves. That's basically the only justification behind it. Other than that, it's just, we haven't focused on it, and it wouldn't be fair to, pull the wool over our eyes and just pretend like we know it and go and buy something. It just wouldn't be doing ourselves a service, nor would it be doing potential investors. But we would never buy it with investors without doing it ourselves first. But that's out from where we're coming from.
Yeah, I think it's a knowledge thing. It's also a strategic thing as well. We can only do so much. We can only focus so many different ways. So it's, you got to pick and choose where you spend your time and energy. And I don't think there's anything wrong with any type of real estate or asset class. I think it's just you have, your understanding of what's behind it, what you're buying it for, and the relationship. There's still nothing wrong with hotels and retail, despite them both basically getting smoked for the past 7 months. But there's still going to be an ask for those seats in the future. But it's, is there too many seats right now? Potentially. Hotels are going to bounce back, in my opinion, at some point. Retail has kind of been on a downward trend for a while, but people still like going places to get things or to do things or to have something done. I could see it being more service-based in the future, but I'm not an expert, so I have no idea. But I think that's the whole point of, we are building up a company that is multifamily focused because it's what we know. And there's only so much time in the day, and, there's only so many shiny objects we can chase. So, we've got to kind of just understand where we're going. As far as the diversification side, I personally think it's hugely important, but there is a really good saying that, people get rich by focusing on one thing, and they stay wealthy by diversifying across many things. So I think especially younger and or newer people, it's less important and more important to get really good at one or a few things. Because if you go an inch wide and a mile deep, I think you have a much better chance of building up wealth, capital, a business, equity, etc. And then once you have money, you don't have to make as much on your time and money because you can be passive. You can do whatever. 5% of 50 million is much better than 100% of 5,000, right? So, when you have less, I think you want to focus more and then over time diversify, but it's also based on you. If you're willing to work for 45 years, you can be more diversified from the onset and take less risk. But if you're like, hey, I want to retire super quick, well, you better figure out a way to quickly start making some real money so then you can, start worrying about preserving your capital and offsetting your income. So I think you just got to back into what you're doing. I think you should always think about diversifying and start that process sooner rather than later, but I don't think there's a right or wrong answer. And I think that's actually a pretty good segue into the last question that I was just on Bigger Pocket surfing, and I thought it was a good question to ask. And I don't even know that I have a good answer for this, but I want to ask it anyway. I'm curious what you think. Someone asked, what do you think is the fastest route to $10,000 a month in passive income?
It's a great question. So the answer is, and I don't care what anyone says, you got to work backwards, right? It's easy to get to 10,000 a month if you have $100 million. Very easy, right? You could almost do anything. You can buy anything and it probably will generate it. But that's not the answer people need to hear, because not everybody has.
Yeah, that's like somebody says, what's the quickest way to be a millionaire? It's be a billionaire and day trade.
Exactly. Yeah, exactly. Because you're going to lose all your money.
Yeah.
No, I like that. But no, I think there is no right or wrong answer here, right? Because I think we just had a great guest on our podcast, Zachary Booth, and he's talking about taking $1,000 and doing a 40-day challenge to turn 1,000 into 40, which is fantastic, right? 40,000 in 40 days. That's more than 10,000 a month. So I think that the fastest way to $10,000 is obviously working backwards. I think before you can work backwards, you have to ask yourself, what do you like to do? What do you not like to do? If you hate construction, I would not do fix and flips. If you hate the stock market, I would not day trade. So I think that you have to start with the end in mind. So to 10,000 a month, that's $120,000 a year. If you wanted to make a 1% return, you would need X million. If you wanted to make a 20% return, you would need Y, Y $500,000, give or take, right? So I think that working backwards will help generate the business plan to accommodate it. Now, piggybacking off of that, I think that you can do it in fix and flip. You can do it in multifamily. You can do it all the way. Now, fix and flip's not going to generate 10,000 a month consistently unless you're doing a flip a month. But the way that I would go about it is see what I have in the bank, see what I can generate with that money, see what I can physically generate by creating a schedule, time blocking, attacking the business, whether it be cold calling, driving for dollars, direct mail, whatever. And then I would look to, do a variety of, put that into a pot, mix it up, and see what comes out. But, you got to assume to make $10,000 a month, if you have $0 to start with, you got to be in for the long haul. It's going to take you a couple years. Because if you have $0, you can't even direct mail, right? If you have $0, you can't even fill your car up with cash. You might have to knock on doors as opposed to driving for dollars. So I think it's an awesome question, because everybody wishes that there was a magic the printer's printing out. That's interesting, right? Everyone thinks there's a magic button or a magic direct mailer to send out and just boom, you get 10,000 in cash flow. It's not that easy. So I think, working backwards will help you define a strategy to get there. But I think that strategy has to incorporate cold calling, direct mail, driving for dollars, knocking on doors, education. You have to find the product that you like, podcasts. And then you got to put all that into a 24-hour day, right? And then, slowly, chop it down, right? You can't eat an elephant in a day, or whatever that saying is. So you just got to put it together. You got to create a plan, and you got to execute on that plan. The quickest way to do it, execute on your business plan. Take action and execute on your business plan.
Yeah. I think one thing that when we talk about passive income, for me, if you're flipping $10,000 a month, that's not passive unless somebody's doing it for you and you're just paying them. And then even then you have to oversee them. So for me, that isn't really passive. I think truly passive is like if you invest in dividend stocks that make you 3% like clockwork. That for me is probably the truest passive you can get in any sense, where you're literally doing nothing at all. The next closest things are investing in syndications or REITs. But if you invest in your own income producing real estate, it's passive, but you're still going to have to spend some time. But I think I would also consider that passive of if you invest in real estate. And I think you really hit the nail on the head when you said you need to back into that 10,000, because you can make 10,000 a month making 1%, or you can make 10,000 a month making 20%. And I think you need to understand what you're looking to do. I think most people that are asking that question are, I want to make $10,000 a month and I don't want to have to worry about ever working again. So I really don't want to lose that money. So I think most people, when you get to that final number, are probably looking for the lower end of that cash flow number, because it offsets a lot of that risk. Talked about it before, talking about it here again. So I would imagine it's in that 3 to 6% range, possibly lower, who knows. So now you're talking about $2 million plus that you need to get to. You need to have something generating revenue for you to then invest that money into passive income vehicles. So you've got to have something that generates you money every single month, more so than your living costs. It could be a job that just produces money. It could be, side hustles with that job. It could be your own business. It can be in real estate, but you've got to back into how much am I going to take home every year in profit? And then what do I put that into? And I think as you're building up that capital stack, earlier on, you can be in more of those riskier passive investment deals. So instead of investing in a 20 unit brand new construction that makes you 4%, you can go buy that self-storage unit that makes you 12%. So you make a little bit more per year and get some appreciation. And then eventually you can sell it and roll it into something else. So it doesn't have to be that 3% deal out of the box. But I think if you are looking to offset, probably want to go into that in the future. So it doesn't also have to be, I'm going to flip or I'm going to wholesale or I'm going to be an agent type thing. It could also be you just have a great job that makes you $150,000 a year. You're going to live crazy cheap for a few years and, bank 100 plus thousand. And then eventually over time, either that increases or your living costs go up because it'd be tough to live like that for a long time. Or you can go the wholesaling route, the agent route, side hustle route. So I think how you make the money is probably the least and most important because it's going to be different for everybody involved. There's so many different routes. It depends upon, where you are and what you do and your resources. But I think anybody can do wholesaling pretty much. I think anybody can do flipping with a little bit of help out of the box. I think anybody can be a successful agent if you take the time, energy required and do it right. I mean, just look at Brian Karp. So I think if anybody goes those three routes, you can be making decent money. But the more important factor is how humbly are you willing to live during that time to get you quicker to saving up that money. Because you make $50,000 a year and you save every nickel, you'll have $1 million in 20 years. You spend every nickel, you'll have zero. You make $10 million a year and you spend every nickel, you'll also have zero. So, revenue is one thing, but expenses are another thing. So, I think it's, backing into it, how you want to do it, how long do you want it to take, and where eventually do you want to park your money?
100%. That is the answer to the question. There is no one wholesale to do it, right? I think you just got to back into what you make, what you want to make, how much can you save, and putting your money to good use. That's how you do it. That's how you get to 10,000. Is exactly Chris nailed it, right? It's not just generating income. It's also cutting back expenses and investing properly, right? Taking the right gambles and taking the wrong gambles. Will help. You could do it by betting on football, right? You could do it, but probably not the way you want to do it. So no, I think you broke it down really good. I like that.
Yeah. I think if you were really like, hey, what is the absolute fastest route? I don't think it's the job aspect. I think it's really the lifestyle aspect. It's of how, are you going to work every single second of every single day? And are you going to live as humbly and cheaply as possible? If you were saying the fastest route, because one person might be good at wholesaling, someone might be good at being an agent. So you can't blanket that across. It really depends on your own personal skill set. But if you want to get to the number you need to get to as quickly as possible, it's how much shit are you willing to eat until you get there? That'll get you there the quickest. I think I've mentioned it before, but there's a chart in the book, Quitting Like a Millionaire, where it's, how to retire, how many years to retire. And it's not a chart that says it doesn't have dollars in it at all. It's what percentage of your income are you saving? And that's how quickly you'll retire. And it's basically the closer you get to 100% savings, the quicker you will retire. It's a little bit flawed because if you live off of zero, it's saying you can be retired today because you don't need any money to live. So it's a little bit flawed. It's a little bit of a give and take, but it's basically saying if I only need to live off of $20,000 and I can save $50,000 a year, it'll take me 10 years. If I need to live off of 50 and I can only save 20, it'll take me 15 years. But it's that percentage relationship more so than physical dollars. So at some point, I can't live off of $10,000 forever, probably. So at some point, that graph will change, but it is a really interesting concept.
100%. Or become a mooch and live off someone and just keep your money in your bank.
Yeah, that's one way to do it. Or inherit a lot of money.
Or inherit a lot of money, exactly, and pay yourself $10,000 a month out of your inheritance.
Exactly. But awesome. I think that's probably a good place to wrap up, unless you have any final thoughts to leave people off with.
No, I think it's good. I mean, I think that the name of the game is get involved, right? Listen to podcasts, educate yourself, do whatever you can. That's the bottom line. But you have to balance out your work life and what you want to do, right? It's a lot easier to do it quicker if you sacrifice a lot. If you don't sacrifice anything, it's going to be harder. Other than that, I agree. Great place to wrap it up. This was fun.
Yeah, it was different. No, I'm excited. Maybe we'll have to do it again. If you guys liked it, would be really curious to hear from you. So if you're listening and you liked it, reach out to us, any social media, our emails. If you have our numbers, definitely let us know. Just curious to hear if you like this or didn't like it. And as always, if you aren't already subscribed to this podcast, it would mean the world to John and I if you do so. And if you are, please send it to someone that would like this episode or another one that you think would get a lot of value from it, because that's what we're here for.
Exactly.
Yeah. So with that being said, thank you guys so much for listening. Good.